All right, just a bit about the objectives. Obviously, we need to look at derivatives. Okay, that's the main focus, and pricing is key. So we need to determine price and value of these instruments. Okay, like any other asset class, a derivative is a potential investment. Okay, it has value, but its value gets derived from something underlying. Okay, so we need to determine how do we value a derivative, i.e., something that derives value from something else. Okay, that's the biggest challenge. Okay, valuing those instruments. All right, so to start off, I've got two questions here I want you to consider. Can you recall one of the most important investment considerations?
Risk versus reward.
Okay, and?
I would say wealth maximization, but I think that's...
Okay, wealth maximization is the finance, which is fine. Remember, from an investment point of view, it's profit. It's trying to reap more reward compared to what we currently have in terms of capital. So taking capital, investing it, and reaping a benefit. Okay, so risk and reward is definitely something to consider. And what else? In terms of most important investment considerations. So risk and reward is definitely one of the top.
Most important. I want to keep on saying risk, but I think risk management.
Yeah, risk and reward, and something else.
Something else. I'm missing.
Timing. Okay, so what is your time frame in terms of period or duration? Okay, so how long are we going to be investing for? What time frame are we looking at in terms of T0, T1, T2, T end? Okay, because that's an important consideration. Okay, and when looking at markets are volatile. So over time, prices change. So now how do we reduce the effects of time affecting price? Okay, so we could enter into contracts where we could fix certain prices today, and depending on what happens in the market, we'll either benefit, okay, if it goes in our favor, or that option or that contract would be worthless if it doesn't. All right, so it's something to consider in terms of strategy, okay, because strategy obviously needs to be implemented in the market. Okay, and there's an element of time there. Okay, you can never ever time the market. Okay, the market is unpredictable. No one knows what's going to happen. Okay, but you'll formulate a strategy and you'll implement that strategy over a period of time. Okay, so you started with a bit of an introduction. You mentioned how tough it is currently in the farming industry in terms of agriculture and omnia. Okay, so in agriculture, right, the yield in terms of crops aren't going to be as high as they were in prior years because we've had a massive drought. Okay, so if farmers had foreseen a drought arising in South Africa, they could have potentially have locked in certain prices, okay, ahead of time, all right, before the actual drought had occurred, or they might have entered into contracts where they could have sold crop that's going to arise in the future today. Right, so time is the biggest consideration in terms of a derivative because we're looking at strategy. Okay, so how do we act today based on what we think will happen in the future? All right, so it's like taking a position today, but not putting all the eggs into that particular basket. Okay, so you want to invest in that particular asset, but there's a big question mark about what will happen in the future. Right, and the question mark relates to time. Okay, because no one knows what's going to happen tomorrow. Okay, we could have another terrorist attack. There's been a lot happening recently in Europe. Okay, the most recent one that I recall is the truck that was that literally rammed through a crowd of people in, I think it was Nice or somewhere in Paris or France. Okay, so that creates a problem from an investment point of view because things like that will affect the market. Okay, what is the investment goal though? Yes, okay, so from an investment point of view, it's return on investment. Okay, so what are we going to receive as a benefit from having invested? Okay, it's maximizing that capital. It's trying to get that capital growing as much as possible. Okay, and capital needs to be managed. Okay, capital can be easy or difficult to come by. Okay, so investment managers need to be responsible with capital because capital is actually part of the owners, okay, in terms of shareholders. Right, so you might be an investment manager managing funds on behalf of your clients. Right, you have to act ethically and you need to manage risk as much as possible. Right, because it's not yours, it's theirs. Okay, so there's a fiduciary duty to make sure you are investing responsibly. Okay, so every investment needs to carry certain, let's say, requirements. Okay, you can't invest anywhere. Okay, you can't invest in a company because you like the company. You need to invest in the company because of X, Y, and Z. Okay, you need to have all of the information in place to make that decision. All right, so the goal is definitely a return. All right, so what are the four main asset classes? They're here.
Stocks, bonds,
Yeah, stocks, so that's equity. Bonds, okay, so that's this one here.
property,
Yes.
cash.
And cash, correct. Okay, so those are the four main asset classes. Okay, are these the only asset classes that portfolio managers can use? No. Okay, so what other asset classes do you get? Okay, so commodities, gold, silver, copper, iron, etc. Yeah, commodities, so currency. So let's maybe, let me rather type this as a bit neater. Okay, so currency, commodities, so currency, commodities, what else? Okay, so you could use derivatives as an option, so interest rates, derivatives, okay, so rates, swaps, futures, etc. Yeah, we'll look at some of those as we go. What else? What other asset classes? Artwork. Okay, art. Precious metals. There's a lot of companies looking at unusual. So it's more exotic in terms of it's not your gold, iron, copper, silver. Those are so commodities are more heavily traded instruments. So like soya beans, coffee, sugar. All right. Precious metals. Those are those exotic elements. Okay, those elements that are on the periodic table that are very, very unique to certain industries. Okay. For example, sure, I forget the name of I think it's iridium or something like that, but it's something that's used in cell phones, okay, mobile devices, right? There's a specific element, okay, that's very, very valuable in terms of high demand and very low supply, right? That's used in certain devices, okay, electronic devices, and that's why a lot of electronic devices can be recycled, right? Because that metal, that specific element, okay, ingredient that goes into making a smartphone can be utilized, okay, in other places. So old cell phones that have the material can obviously be recycled, and that's why normally companies often ask for those old headsets, right, because of the value in terms of metals that the particular device has. Okay, what else?
I suppose anything really.
So the more exotic could be something like stamps.
Yes.
Okay, vintage cars.
Yeah.
All right, almost everything, antiques. Okay, so in terms of investments, okay, what are we considering? We're considering diversification because diversification helps with managing risk. Okay, so we don't only look at the four asset classes because there are lots of other asset classes that we can consider. And if we do consider other asset classes, that adds diversification. So we're not investing in one asset because one asset will behave very differently in certain types of market conditions. Okay, if we've invested widely, okay, bonds might perform well in 1 year, in another it might perform quite badly. Okay, so since having completed your bond module, what has happened in South Africa and in the US? Correct, yeah, the rates had gone up. Okay, there was lots of speculation about rates rising, and the first hike in America was in December. Okay, and then in South Africa, obviously, because of our bad unemployment numbers and high inflation, right, rates have obviously gone up a lot more in our country than in other parts of the world. Okay, Alright, so that's a note about asset classes. Let's have a look at a derivative. So chapter 1 is defining this derivative, okay, in terms of an asset, okay, and it's also defining the market. So what do you require in order to have a derivative market, a functioning derivative market? Okay, so for example, primary and secondary markets, okay, primary market is what?
First time selling.
Correct. First time when you list on an exchange. Okay, so who would be the role players that will be involved in that process?
The company itself listing.
Yes.
JSE, obviously.
Yes.
First set of buyers.
Which would be the banks, yeah. All right, so corporate banks, okay, big corporate banks, and the, let's say, the companies, okay, the individuals trying to issue those shares or bonds, okay, would be the two main role players in establishing the primary market. Okay, once those instruments have been issued, what do those banks then do? Okay, resell. All right, so those instruments are then sold to third parties, and those third parties could be asset managers, they could be pension funds, they could be normal citizens, everyday people, other companies, it doesn't matter, government. All right, but the secondary market is where we would buy and sell those assets. Okay, so when looking at a derivative, okay, there needs to be a market for those products as well. Right, so if a